Good to see you.
Good to see you as well.
Are you in the 5% 10-year camp?
I think in the short term, you have to keep all options on the table. I think it's possible that we can touch 5%. I do also think this is actually a very good buying opportunity for kind of a longer term investor. We think the year is going to be divided into kind of two halves. The first half, we've got the Fed on hold, so we do expect them to stay put. And then the second half, as growth starts to slow down, as you guys were just talking about, certainly we'll start to see rates drift a little bit lower. Not quickly, but I do want to be positioned long over the course of the year.
So you don't see a point where you're going to have Fed cuts and the long end move higher like we have seen?
So the curve will probably steepen, but it doesn't necessarily have to be, kind of a twist steepening of the curve where the front end comes down and the long end goes up. All yields will probably fall, so I do expect the 10-year to finish the year lower, but I do expect the curve to steepen. Term premium will continue to kind of push a little bit higher. So there are going to be multiple dynamics within the curve.
Well, part of those dynamics, too, is also where inflation goes, right? I mean, 5% is great, assuming, inflation isn't 5% as well. So how do you balance that out? I know it's hard to make an inflation prediction right now, given we're kind of at this inflection point, but I'm sure you've had to try to model something.
Yeah, I mean, certainly, the big question is Trump tariffs, right? And how much they add to inflation, how quickly they come in, what products they're on, who they're even imposed on. Are Canada and Mexico included in that? Yeah. And certainly some of the more pessimistic scenarios can push inflation sharply higher. Yeah. Our expectation is they will probably add about a percentage point to inflation, and that's why we have the Fed remaining on hold in H1, looking through whether they're going to be unanchoring inflation expectations.
That's interesting too, because when we were looking at the Fed minutes that came out about an hour ago, they talked in the Fed minutes about how a lot of members basically put placeholders for their inflation and economic targets, primarily because of the uncertainty around the new administration. So my question then really, as an investor, do you have to wait until Trump makes good on some of those promises, or do you take those promises that he made on the campaign trail and assume they are going to be reality?
Well, the question is which ones, right? So I think a lot of investors are holding off until they get a better sense of what's actually implemented. As we saw in the press conference yesterday, there are going to be new promises that are made. I think a lot of investors are saying, let's wait a little bit, let's wait a little bit, let's wait a little bit. Yeah. And that's why you're seeing that lack of buying that's come through. It started last year. People were saying, let's wait until the Fed. And then they were saying, let's wait until Trump comes into office. And now I think it's really until payrolls, until CPI, and until Trump comes into office. And then you'll actually get a little bit more clarity. People hope. But I do think, I agree with you, I do think these rates are already attractive. It makes sense to get in now.
Yeah, that press conference is crazy. By the way, we have to have a conversation at some point. Is Greenland going to be inflationary to the U.S. if we buy them?
I don't know. I listened to the whole thing. We brought it to you on Bloomberg Radio. So it was a lot. There was a lot of stuff, substantive and otherwise, but it kind of all mashed together. So is this what we learned? Like through the auctions this week, the 3, the 10, the 30, like is 5% going to be that cap now? Because we're seeing buying come in when we get near that point.
I think it has to be a bit of a cap in the short term at least, simply because if you're looking for rates to go past 5%, you're either expecting a massive amount of issuance, which really nothing has changed on that front. I think a lot of this move higher in rates has been growth driven rather than issuance driven or issuance expectations driven. And I do think you have to figure out how much of this has been, the tariffs as well. So look, I do think 5% is an attractive level. Is it the cap? Probably in the short term. Unless you expect the Fed to hike rates, which again, as we're penciling out rate cuts, that becomes a greater possibility. I still think that's a very low probability for the rest of this year. So
when we take a look at the credit market for a second, we've seen some high-yield issuers start to issue on the front end or in the belly of the curve rather than the back end, because the back end is getting too pricey with which to do that. What does that do? That's a very weird thing, right? Usually you want to term out your debt.
You do, except that everyone kind of wants rates to come down, or at least on the issuance front, and you're seeing very tight spreads in the credit sector out there because you don't have a lot of supply and a whole lot of demand for investors looking for very high all-in yields. That's why credit spreads have done so well. The problem is you have a lot of companies that want to issue in the front end and everybody who wants to buy in the back end, right? So there's a bit of a mismatch. It hasn't gone too poorly. The market's doing just fine, and there's a huge amount of supply out, as there always is in January. But it is actually helping to push long-end rates up a little bit higher as well because there is that amount of supply out there.
So you are believing in the price action. You think that what the Treasury market is reflecting, or I should say the bond market overall is reflecting, is a relatively accurate, or at least as much as we can believe it to be accurate.
I mean, it's always accurate. The question is, does it stay? stay,
Okay.
and does it continue to move higher?
Yeah.
Or, there's certainly folks out there looking for much higher interest rates from here.
Yeah.
I think we're towards the top of the recent range.
Right.
So I would be a buyer around these levels.
But going back to your comment, too, about how the Fed probably is going to raise interest rates unless there really is some huge, resurgence in inflation. At 4.5% or 4.25 on the lower bound on the Fed funds rate, is that enough, do you think, to tackle inflation? I mean, let's just say they stand pat there. Do you think that would do the job?
Yeah, I don't think policy is easy at any point. I mean, we're all talking about, whether it's us or the Fed, we're all talking about the level of restrictiveness of policy. No one's talking about how easy policy is. And certainly there are some problems of transmission. I mean, you've got, something like 70% of the country having locked in a mortgage rate of below 5%, right? That's not going away anytime soon unless rates fall dramatically. So really what we're talking about is how restrictive is policy, and is it enough to actually slow down inflation? I think it is over time, and I think that's why the Fed is becoming a little bit more cautious, because they want to keep rates slightly higher for slightly longer to try to get that inflation lower down to 2%.
All right, great stuff, man. One of the best on Wall Street.